Bitcoin just dropped thousands of dollars in a matter of hours. The reason? The latest U.S. inflation report. The producer price index just surged to 3.3%, far above expectations. In today's video, we'll break down what this means for Bitcoin, the crypto market, and whether this crash is short-term or something more serious. Stay tuned, because this could affect your crypto portfolio. First, let's understand what PPI is. The Producer Price Index measures inflation at the wholesale level, basically how much producers charge for goods and services. When PPI rises faster than expected, it often signals that inflation is heating up, which can force the Federal Reserve to delay interest rate cuts or even raise rates. For investors, this is important because higher rates mean less money flows into risk assets like Bitcoin. In July 2025, PPI rose 3.3% year over year, the highest since February, and above the 2.5% analysts expected. Even more alarming, the monthly jump was 0.9%, the largest in 3 years. As soon as the PPI data was released, markets reacted sharply. Bitcoin, which had surged to an all-time high of $124,234, quickly dropped to around $118,688. That's more than a $5,500 drop in hours. Why did this happen? Higher inflation means the Fed might not cut rates as expected, reducing liquidity in the market. Investors, especially in crypto, often react quickly to such macro news. Let's look at the technicals. Bitcoin recently hit resistance at $124,000, which is also near its all-time high. The RSI, a measure of overbought conditions, is showing bearish divergence. This suggests that the recent rally was losing steam even before the PPI news. With the PPI shock, BTC dropped to the next support level around $118,000. If this support breaks, we could see a drop to $110,000 in the short term. On the other hand, if it holds, we might see a rebound once the market digests the news. Bitcoin has historically reacted sharply to inflation reports. For example, back in 2023, a higher-than-expected PPI report caused a temporary 7% drop in BTC. Usually, these corrections are short-term unless accompanied by sustained macroeconomic pressure. Comparing the current situation, the PPI jump is significant, but the fundamentals of Bitcoin, adoption, scarcity, and institutional interest remain strong. It's not just Bitcoin. Other risk assets are also feeling the impact. The S&P 500 and Nasdaq dropped in response to the PPI data, and major altcoins like Ethereum and Binance Coin followed suit. Institutional investors like Maki Big Brother have already started profit-taking. Large movements like this amplify market volatility. Why does the PPI matter for the Fed? The central bank's main goal is controlling inflation. If inflation rises faster than expected, the Fed may delay interest rate cuts or even raise rates. This has a direct effect on Bitcoin and other cryptocurrencies because higher rates make borrowing more expensive, and risk assets like crypto become less attractive compared to safer investments. Some analysts believe that the current drop is just a short-term correction. Others warn that if inflation continues rising, BTC could see further downside pressure. Market sentiment is fragile right now, and the next few weeks will be critical in determining whether this is a temporary dip or the start of a bigger correction. What does this mean for your portfolio? Here are a few key points. Don't panic. Short-term dips are normal in crypto. Watch support levels around $118,000 and $110,000. Keep an eye on future inflation reports and Fed announcements. Diversify your portfolio and avoid over-leveraging in volatile times. To summarize, Bitcoin's recent drop is largely due to the 3.3% PPI rise and inflation concerns. While volatility is high, understanding these macro factors can help you make smarter decisions. If you want daily updates on crypto news and market analysis, hit that subscribe button and turn on notifications. Stay informed and stay ahead of the market.